Okay, let's turn to the latest in the markets. As our next guest says, stronger, broader earnings and participation will be the story for 2026 and not necessarily rates. We are joined now by Mike Dickson, Head of Research and Quantitative Strategies at Horizon Investments. Mike, thanks very much for joining us.
Hey, Roger, thanks for having me.
Okay, so what makes you think that broader earnings and participation are going to be the story?
Well, as you mentioned, we've seen a little bit of rockiness the last few days with the top of the market. But when you look at what's happened year to date, you do see a very strong response in that kind of smaller mid cap space. With down here in the States, S&P 600 or Russell 2000 up in the 5 to 6% range, with the large caps kind of converging to zero the last few days. And I think in large part, when you look at what's been happening with earnings over the last few quarters for a lot of these companies, you're seeing a pretty big uptick in earnings growth expectations and a pretty strong momentum forward there. So whereas last year we had a huge concentration of earnings just amongst the top largest companies, you're now starting to see double-digit growth on a forward-looking basis start to appear for some of these smaller mid-caps and other broader cyclicals. And that's a really good sign as we head into the year, very healthy.
And what's fueling that?
Well, I think overall, one of the things that's fueling that, at least on the smaller mid-cap side of things, it was the overall level of interest rates, right? That has been for companies in the smaller mid-cap space that don't have the balance sheets and cash flows that a lot of the mega caps have. That has definitely been a major macro factor that has kept prices kind of suppressed in that area of the market. And we have obviously seen a pretty strong reduction in rates over the last 12 to 18 months. And that's getting to a point where these companies are able to really absorb that. Another thing, I'll point to, overall is just zooming out at the broader economic picture from a consumer strength perspective. And that consumer spending has really been powering GDP quite a bit higher than estimates. And we saw that as well with recent Fed upgrades to those estimates for 2026. And so you've got a very strong consumer in spite of kind of a labor market that's not really growing, but not really shrinking. I think taking those two things combined, those macro forces kind of coming off the table a little bit, but also powered by that strong consumer is where you're starting to see that strong inflection higher. And again, that's the health that we're that we really want to see after the last couple of years where markets have been incredibly concentrated at the top.
And with consumers, any concerns that the resiliency may be running out? They seem to keep going. We talk about the fears of them taking a hit, but it seems that consumer resiliency continues.
It really does appear that way. And, just even today, we got, another retail sales report still for the month of November due to some of that economic shutdown still causing some lag in the reporting of some of this data. But the last couple periods that we've seen for that retail sales, especially for the numbers that are flowing through to GDP, you've got very much above trend retail sales estimates, showing strong consumer strength there. And then if we just look back at the end of December, we got that Q3 GDP number here in the U.S. and you saw a substantial uptick of around 0.8% compared to estimates, having that GDP land in the low 4 range, powered by that consumer spending side of things. So when you're looking at these kind of statistics, it tells you that not only are consumers spending a lot, but there's still a significant amount of money on the sidelines when it comes to money market fund assets. You still have a significant amount of home equity tied up there with the potential for falling rates to boost that side of the market. So, with positive real earnings and some of those other backstops I've mentioned, not only do you have the spending, you have the fuel to continue to support that spending. And I think that's a great sign for these smaller mid-cap stocks.
Okay, now it has been an interesting start to the year. I mean, we're officially 2 weeks into it, I guess now. And Venezuela, the Powell attack, now the credit card caps. Any concerns about things like that as we head get more deeper into 2026?
Well, there has been a lot. There certainly has been no shortage of headlines. A few that you mentioned there, certainly stand out. I think one of the things that does stand out to me as it relates to, outside of the Venezuela situation, some of the other announcements by the administration down here, specifically on the credit card side of things, as well as directing the GSEs to begin purchasing additional MBS to help reduce interest rates on mortgages. One of the things that stands out is this kind of affordability theme, right? Is kind of running through all of this. A lot of the administration's policies that have been proposed that does run kind of central through all of that, and I think that's really setting up to affordability being something that the administration is going to focus on as we head into midterms this year. And the other thing I would say about some of these announcements is it's not entirely clear how a lot of these things are going to be implemented. And so the short-term market impacts, may not be permanent. There's a lot more to do to figure out how a lot of these policies that have been, just tossed out there are actually going to be implemented, and are they going to have the intended effects? That's also not entirely clear. So a lot of information for the market to digest, but I think for now those short-term impacts, are not really going to be have a lot of staying power, and the focus on earnings is going to be the main driver as we head over the next few weeks for what 2026 is going to look like.
And you're liking the small and mid caps. Any certain sectors within that, or where are you focusing?
Yeah, I think while we have had the last few years very tech forward types of focus, of course, starting with the AI theme and the mega caps and kind of working their way down the spectrum, I think what you're going to see this year amongst large caps and the smaller caps as well is a bit more of a value cyclical focus. And what I mean by that, and really what's driving that, is this very strong inflection higher that we have had in economic growth estimates, and then the actual realized data. So, with kind of rates coming down, with GDP growth as high as it is, and expected to continue, and then you also have, from a fiscal standpoint, quite a bit of boost as well with the One Big Beautiful Bill Act, and there's other incentives out there that really support a lot of strong spending. And I think that that's going to make a lot of those lower valued areas of the market that have that higher beta cyclical exposure to the economy really be set to take off. And so I think industrials and materials, which can be thought of as kind of like an AI adjacent trade, getting a lot of that CapEx put to good use. And even some of the smaller cap banks here in the U.S., I think all of those are really poised to do quite well as we head into 26.
Okay, we have to wrap it up there, Mike, but thanks as always for joining us.
Thank you.
Mike Dickson, Head of Research and Quantitative Strategies at Horizon Investments.